Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 128 of our YouTube channel and podcast. And I could not be more excited to continue sharing with you guys personal finance topics that I think could be really useful to you in your long-term financial journey. Today, what we are going to talk about, as we talked about value investing in yesterday's episode, today's episode is all about growth investing. And again, as I said with value investing, there are tenets of growth investing, just as there were tenets of value investing that we have talked about previously, but I have not dedicated an episode to it, and I have not told you all that you may want to or need to know about growth investing. So we are going to spend today doing that, understanding what growth investing is, how growth investing can impact your money, how you can use it to become a better investor and make better returns over the long term. So hopefully this episode helps you and can allow you to become the best investor possible. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything that you leave down there. If you're listening on Apple or Spotify podcasts, then just make sure to subscribe and leave me a review on either one of those platforms. Also, follow me on social media at MNO with Dylan. And this is good supplementary content to all the things that I'm putting out in the long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you with your long-term financial journey, create a plan that you can work and to help you stay accountable to that plan, I can help you to do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. All right, so what is growth investing? Well, growth investing along with value investing, those are two of the most commonly stated strategies and two of the most common types that have persisted over a long period of time. And there are what's known as value stocks and there are growth stocks. And today we're going to spend all of our time, most of our time, just talking about the growth stocks and talking about what growth investing is and how growth investing can help you. So what is growth investing? Well, first, it is the approach that refers to buying stocks attached to businesses that have attractive characteristics that their rivals lack. And these can include easily measurable things such as the growth rate in their sales or earnings. They can also include more qualitative factors such as consumer loyalty, valuable brand, or formidable competitive moat. And so if you'll remember, when I was talking about value investing had to do with determining an intrinsic value and the particular stock trading below its current intrinsic value. So you want to create that margin of safety and have enough room in order to buy something below its intrinsic value and the value increase to or above that intrinsic value. Well, growth differs in that way because they're not necessarily just looking for things that have value that is not shown in the market. They are looking for things that have good value moving forward. They're looking at things just from a futuristic perspective. They don't necessarily mind that something doesn't have those characteristics of value stocks that we talked about yesterday. They don't care if something does not have consistent earnings or stable revenue streams. Or they don't necessarily care if something has a long-term history of success in what particular industry or business they are doing. They don't necessarily care about that. They care about what the future is going to look like. And so you can see how this differs greatly from the value investing point of view. Now, the thing about growth stocks is that they tend to hold promising positions in emerging industries. And so typically growth stocks have to do with new things that are coming into our markets, new things that are relevant in the world that we're living in, and they show themselves up as growth stocks. And they feature long runways for expansion ahead of them, meaning they have a lot of ability to continue forward, to continue pushing into the future. And so that's what a growth stock is typically going to look like. And because of this desirable potential and the unusually strong success that the business has had in recent years, and that's the key, in recent years, you've seen recent success, a growth stock is priced at a premium that reflects the optimism that investors have in the company. So when I was talking about value investing, you were trying to find something that is trading at a discount. It is trading at a discount to earnings, a discount to cash flow, a discount to revenues. But with growth stocks, we're learning here that growth stocks tend to trade at a premium. And the reason that this is that when you're trying to determine what something is worth today, what something should be selling for today, as far as a stock goes, you are taking the present value of all future cash flows. Well, in order to determine what future cash flows are going to be, you need to know what the growth rate into the future is going to be. And the higher the future growth rate that is determined, then the greater that particular value will be today. Now, if you just look into the past with some of these growth stocks, and I mentioned this a bit yesterday, if you just look into the past, then you may not see the relevant data and the proof that something should be trading for the price at which it is trading. It may look overvalued in a particular way. But if the price of a stock is truly due to the present value of all future cash flows, which it is, and the market is assuming a certain growth rate into the future, then that premium can be exactly what the stock should be trading for. And you see many stocks that do this over time. Now, the simplest way to know whether or not you're looking at a growth stock or not is to look at their valuation metrics, look at their valuation ratios. And these are things like the PE, the price to earnings ratio, or the price to sales, or price to book, or price to cash flow ratios. And those will be higher than the broader market and the industry peers. And the reason that it is higher is that the current price, right? So that price, again, is based on some growth assumption in the future, is being juxtaposed, is being put in the numerator of this division, right? Price to whatever, earnings, book, value, to the cash flow, to the sales, whatever it is. Those things are backward looking. You are looking at things that happened in the past. And so something trading at a high multiple is typically a growth stock, just because you are assuming some growth into the future that is making that particular stock priced so highly today, but you are comparing that with this particular backward-looking metric that doesn't look at the growth into the future. And so you'll see those high multiples. Whereas, like we said, with value stocks, you are typically looking at lower multiples. And so growth investing is seen as riskier, and there's two main reasons why this is the case. First, it involves paying more in relative terms. Okay, so you are paying more for some previous stream of earnings or some previous stream of revenues or cash flows or whatever it may be than somebody else may be if they are purchasing a value stock, right? You are paying more relative to what you've seen in the past. And that's what those valuation metrics tell us, right? They tell you how much you are paying per dollar of earnings, or how much you are paying per dollar of cash flow or per dollar of revenue, or whatever it may be. And so it is trading at that higher price, and it is more expensive in relative terms. But that also gives you a greater risk of market declines, and a greater risk that the future growth rate doesn't work out. Because if you purchase something that's already trading at a premium to what the past tells you it should be trading for, and then you look at what the future growth rate should be, and then something happens that is going to directly impact what the future growth is going to be, then not only are we going to see the price fall, you may also see the future earnings and future revenues and what you expect out of them to fall as well. And so you can see some precipitous drops in stock price with a growth stock if the future doesn't pan out, or something gets in the way of the future panning out. Now, another reason that it is seen as riskier to be investing in growth stocks is because so much of a growth stock's value is predicated on future gains. Even a small change in investors' perception of that potential could have a large impact on share price. So that goes back a lot to what I was just talking about, right? If there is some thing that is going to have an impact on your ability to make certain returns in the future, or produce certain cash flow in the future, then it is going to heavily impact today's stock price. So what that's going to create within growth stocks that is not as prevalent in things like value stocks is volatility. And we know that volatility is just the variation in stock price, the variation in the price of the stock over time. And this is one of the reasons that when we look at the stock market, we don't just want to be investing for a short period of time, because growth stocks can have a lot of good upside potential. They can have a lot of potential for future gains. And a lot of people make a lot of money investing in growth stocks. But if you do it for a short period of time, the volatility of the market could really destroy whatever gains you expected to make and destroy the value of what you are investing in. Okay, so let's look at what it takes, the steps that it takes to invest properly, to invest effectively in growth stocks. So the first thing that you need to do is get comfortable with a growth approach. Now, a growth approach is going to look a lot different than a value approach. Because a value approach, again, is you're trying to find something that is a bargain, something that is a discount, and buy it and then let it increase in value to what it is actually worth. Whereas your growth approach differs quite a bit. But you need to get comfortable with thinking about stocks in this way, thinking about companies in this way. If you can only pay attention to large, well-established companies that pay dividends and companies that already have shown you that they have had long-term positive earnings and steady revenues, and they have a long-term success track record that you can look at. If those are the only ones you care to look at and what you are most interested in, then growth might not be the best for you. You have to get comfortable with looking at companies and saying, what does the future hold? Being a bit of a visionary, right? We don't know for sure what the future is going to hold, but being able to look at industries and companies and saying, how is their growth going to be affected in the future based on, what the economy is doing, where the society is going, where the industry is going, and understanding where you can get certain upside based on future growth potential. And what is critical is that you choose one approach and you stick to that approach, because if you are floundering around trying to figure out, okay, is this a value or growth, or do I need to find a margin of safety or future growth rate or whatever, then you can get very confused and make some bad decisions in the future. And so anytime you're just trying to change your approach just so you can make the best returns, right? Because we know that the market goes through cycles. It goes through cycles of value winning and growth winning, and value winning and growth winning. And the best way to make sure that you underperform it, the best way to make sure that you don't make money in the stock market is to try to switch approaches when the market switches approaches. You are chasing returns if you are switching up approaches constantly. So stick with one, understand what you're doing. And if you are going to stick with the growth one, then there are some things that you have to understand about companies. And one place to start, if you need kind of guidelines for how to invest in growth stocks, how to invest in growth companies, one of the best books out there, and other people have recommended as well, One Up on Wall Street by Peter Lynch. I've actually reread that book several different times, and it's a great book, and it's not just based on the growth strategy, but he does tell you how you can realize growth companies and understand how to invest in them and hold them for the long term. So get to know that particular approach. Now, when you are selecting stocks, right, it is risky, right? It is risky to select growth stocks. It's risky to select stocks that don't have a proven track record, that don't have this long-term showing of success and proof of success like certain value companies do. But what you want to do when you're investing in growth stocks is you want to screen for certain different characteristics of stocks. So again, I've told you about how you would look for a value stock. Let's talk about how you would look for a growth stock. So you want above average growth in earnings or the profits that the company generates each year. Okay. So we talked about with value companies, you want the stability of earnings and consistent profitability. And with this, we're looking at above average growth of earnings. Okay, so we may not be where we want to be earnings wise just yet, but are they growing faster than usual? Then you want to look at above average profitability. And when I say profitability, we are talking about operating margins. We're talking about net profit margins, things like that, where the company is getting to keep a lot of their profits. They're going to keep a lot of their revenues because they don't have high costs And so that will allow them to grow faster into the future. Therefore, look for high profitability margins. And then high historical growth in revenue or sales. So again, this contrasts with the value approach because we're looking for the stable sales. We're looking for stability within our revenues, but now we're looking for high growth in revenue or sales, which is no surprise. And then you want high return on invested capital, which this is an efficiency measure of a company, and it tells you how efficiently the company spends their cash. So if they have all of this invested capital, and a lot of growth companies have a fair amount of invested capital, then you want to see the returns they are creating on that invested capital. And if that is very high, then that will be something that you are looking for in a growth stock. Now, at the same time, you want to look for red flags. You want to look for things that may not be indicative of the type of growth stock that will make you returns over the long term. And it will create some riskiness that maybe is not something that you are looking for and may not create the returns that you want to make. Now, some growth investors will argue with me about this, but I think it's very, very important. I talked earlier about how earnings can be something that these types of companies don't have yet. They don't have positive earnings. They don't have a positive net income. They can be operating at a loss. Well, if a company has booked an annual loss for 3 consecutive years, that may be something that you can't overlook. That may be something that you don't want to overlook. Again, this is not a deal breaker, but I don't know if I would be interested in investing in something that did not have positive earnings or had booked 3 straight years of negative earnings. That means there has to be something that is wrong or broken within the business model, at least for now. There is some reason in which that is. And maybe you snuff out that reason and you realize that it's them trying to innovate or whatever it may be, and that they're creating good, those profitability measures, obviously not the net profit, but maybe on operating margin, they're providing good profits or whatever it may be. But really look out for that if there's a company that has had losses over 3 years in a row. It may not be the best thing that you want to invest in. Then companies that carry a very low market cap. And so for those of you who don't know, the market capitalization is nothing more than the price of the stock times the number of shares outstanding. Okay, and that gives you the market capitalization. And a very low market capitalization would be one under 500 million. Okay, and you may say 500 million, that sounds big. And not when Apple is a $2 trillion company. Okay, so tiny stocks are vulnerable to bigger competitors that can disrupt or threaten them as a company. And this may be something that you really want to look into. Are these industries vulnerable to bigger companies just stepping in and saying, well, hey, we can do that, and doing it cheaper and more efficiently? Now, something that could end up happening is that you end up seeing that a company is doing something that a larger company can't do, and a larger company may want to buy them. Well, that can be beneficial to you as an investor. So in that case, that would be acceptable. Now, a lot of investors feel comfortable in the mid-cap range of investing in growth stocks because that still gives them plenty of room to move forward, but it gives you plenty of track record. It gives you enough understanding of what the company does. It gives you enough of a business model that you could say, okay, these companies can still grow forward. But obviously, if you get too big, then the growth aspect tends to wane quite a bit. Okay, then something else that may be a red flag is that there was a recent management shakeup or a change at the CEO position, and that can really turn a company on its head, especially a growth company that may be planning to do all these things in the future. Well, their whole vision can change just based on a CEO. But maybe a company's vision needed to change, and maybe it changed for the better, and it's actually going to create more value for shareholders over time. So just be wary of that. Then also look and see if sales or profitability is not growing, right? It won't qualify as a growth stock if these metrics of sales, cash flow, earnings, things of the like are consistently falling. We want to see those things rising and rising at an above average rate. So make sure that we're not seeing these waning growth rates, this falling of growth in sales or profitability. And then Last red flag that I'll talk about is excessive debt. A lot of companies, in order to try to grow fast and do everything that they want to do into the future, what they will do is take on lots and lots of debt. Well, remember that debt is going to be a hindrance on cash flow. And if we have a lot of debt going into the future, then we will have less free cash flow in the future, which will decrease the market price of a stock today. And it will make it more difficult for the company to operate in the future if it hits any bumps in the road, if it is excessively in debt. And so carrying significant liabilities, right, can get the company into trouble, especially during industry downturns. And industry downturns occur, especially when you're talking about cyclical industries or industries that may be brand new and not very well established in the market, and people may not understand them as well, and their earnings or revenues can really take a hit from time to time. And so if that were to occur, then servicing your debt can be a lot more difficult than ever expected. So excessive debt can be a problem. Now, how do we go about maximizing our returns in growth stocks? Well, we've talked growth stocks tend to be volatile, right? There's a lot of price change, and there may be things that you need to keep in mind and keep your eye on when you see certain changes in your portfolio. So if a portion of your holdings have gained so much value that they dominate your portfolio, you may need to do some rebalancing, take a little bit off of that particular company, of that particular holding. Because again, growth stocks are riskier, and so the risk of a downturn that's really going to hit that stock hard is much, much higher than it would be for some type of value company. And obviously, the more that it dominates your portfolio, the more of an impact it's going to have on your overall holdings. So keep that in mind. And then if a stock rises far above your estimate of its value, you can consider selling it, especially if you've identified another more reasonably priced investment. So if you think a growth stock has outrun its ability to grow to that level, then you may sell it and either wait for it to come back down, maybe buy some more, or maybe find something else that has more ability to grow over the long term. And then if a company has hit a rough patch that has broken your original investment thesis, right, or the reason that you bought the stock in the first place, you might want to sell. And I just want to pause here for just a second, because this is something preached by so many people, and especially Jim Cramer. If you guys have ever watched Jim Cramer on CNBC, Jim Cramer talks about doing your homework on companies, obviously, being able to understand their revenues, their earnings, listening to earnings calls, all of these different types of things, and doing your homework on a company, and then you change when the story changes. When the story changes, if the reason that you bought the stock is no longer the case, then why do you still own the stock? Right? That's the basic thesis, the basic idea. The basic idea of all of this is that if the reason that I bought something does not still hold up, then why do I still have that thing? For instance, if your kid says, "Hey, Dad, I want to go play football this year." You're like, "Okay, cool." So you go and you buy them some football equipment, right? But what if your kid says, I don't know if I was really serious about that. I don't know if I really want to play football. First of all, I'd be a little frustrated because I went out and bought the stuff. But what would you do? You would take the stuff back. You wouldn't just keep the football equipment because your kid is not going to play football, right? And so in the same way, if you look at a particular company and you thought that the company was headed in a certain direction, and they thought they were headed in that direction, and then something material to the company is to change, then you need to change too. Your holdings need to change too. Your idea about the company needs to change too. And sometimes that can just be selling a stock off. Sometimes that can be trimming a position. Sometimes if the story changes, it can change for the good. And it may mean going out and buying the position, right? So keep that in mind. Keep in mind that as the story changes, you may need to change too. Now, for those of us out there who want the exposure to growth stocks, but we don't want to pick individual stocks, which, hey, like I said, most people do not need to pick individual stocks, then there are a lot of good ways that you can do that. You can buy growth mutual funds. You can buy index funds that are concentrated in higher growth areas. And, this is something you can for sure do. You can for sure own companies like this. And owning a large diversified portfolio of growth stocks can beat the stock market, and a lot of mutual funds have. A lot of different indexes that have more growth potential have done so, have beat the S&P 500 over time. So you can definitely do that with your particular funds that you want to purchase. They will provide a little more volatility and a little more downside potential, but not as much as owning specific stocks that are growth stocks, because specific growth stocks, if you let's say you own 10, right, and let's say they're all equally weighted, and there's a big hit in an industry, or the market falls hard, or whatever it may be, then the value you may lose may be extremely high. And so purchasing a large diversified group can really bring down some of that single stock risk, but you're still going to have the overall risk of the fact that these companies are trading at a premium. They are higher growth companies, and any type of decline can really bring them down hard. And these can be added to a portfolio along with funds that may be more value-oriented funds or things of the like. And so you can definitely own these types of things in a mutual fund, and it may be better for you to do it that particular way. But just remember, if you are buying growth stocks, if you are buying individual growth stocks, just understand what they are. Understand that we are long-term investors. Understand that we are not just trying to trade in and out of things. If you believe that something has long-term growth and you've done the homework, and you can have an investment thesis, a reason for buying something, and that reason continues to hold up, then great, hold it, continue to hold it, continue to hold it. But if that investment thesis no longer holds up, then you may need to make some changes. I myself, if you want to know where I sit on this particular ideology, I think that you can not necessarily straddle the fence between value and growth, right? But I think you can try to find the value of things, right, and still have a portion of your portfolio that you are investing in higher growth, maybe more risky stocks, right, and not just trying to find the value in them, because what we are ultimately trying to do is maximize long-term returns, right? And what I said earlier about switching between approaches is just following the market. I'm not saying following the market. I'm saying there are obviously stocks in the market that are undervalued, and you can go find those, and that is a value investment. But there are also stocks that are in new industries, that are innovative, that are going to create a lot of long-term growth, and you can purchase them as well and have a growth play within your portfolio. In the same way that if you're buying funds, you can own growth funds and value funds. That doesn't mean that you're switching in between the two. What it would mean that if you're switching in between the two would be if you were okay, well, we're kind of in a growth market, growth's dominating, let me go buy this growth fund with all of my money. Or if we're shifting to a value market, let me go buy a value fund with all of my money. It's just doing it in that way. I am not paying attention necessarily to a market trend in that way. I'm trying to find companies that have value, and growth stocks do have value, right? They are adding value consistently, but the difference is they are not trading at a discount. They typically are not as big or as stable, and they have a lot more volatility to them. And if you cannot bear that, you should not be out there buying growth stocks. And you definitely should not be buying stocks that are growth stocks if you have not done the homework, if you have not understood what that company is doing and how it is going to create growth into the future. Don't just buy a growth stock on a tip, because those are the kind of stocks that do get bought on a tip. And that's the reason that they're extremely volatile too, is because a lot of people will trade in and out of them real quick. And, oh, that's too much volatility. Oh, it fell hard, so a bunch of people sold and all this type of thing. No. If you think that something has long-term value and can grow over the long term, then by all means, go for it. But understand your approach, stick to your approach, and you will be better off for it. And if you aren't a growth investor, that's perfectly fine. If you're a true value investor, you want to follow the smart guys too, then that is perfectly fine. But if you want to reach for a little more risk and a little more return, then growth investing may be for you. So I hope this helped you to understand what growth investing is a little more, understand if it's something you're interested in, or you may want to buy a fund that holds growth stocks or things of the like, because that could be beneficial to you. But maybe you understand this investment ideology a little more, and maybe it helps you to make better investment decisions, especially given that growth stocks are so heavily talked about and people buy them with no basis as to why they purchase them. So let's not do that. Let's do our homework, and let's be good long-term investors. So thanks for tuning into this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below if you haven't done so already. Follow me on social media at MNO with Dylan, and that's good supplementary materials to all the things that I'm putting out on these long form episodes every single day. If you are listening on Apple or Spotify podcasts, then make sure to subscribe and leave me a review there. And then if you need help with your long-term financial planning and creating a plan that would work for you and keeping somebody to keep you accountable to that plan and work through it with you and stay with you for the long term, I can do that for you. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as we talk about rules for investing that never get old, and hopefully those can help you to really stick to things that will help you be a good investor over time. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.